We traded 30,000 SPX 0DTE trades using AI and robots. Let's show you what worked. My wife and I trade together every single day. She's a former banker and successful house flipping investor. I started and sold two internet companies. I retired at age 42. I'm an attorney. Most importantly, I'm a professional gambler. Our motto on our channel is math makes money. Let me explain how. Over the last year, we had AI backtest 20 million trades a week. Our AI robots executed 30,000 SPX 0DTE trades. Let me show you how we learned that math makes money. Before we get started, I wanted to show you quickly the results that we've achieved. Even in the last 90 days, for every $1 million invested in our funds, we made $218,000 on 7,813 trades, capturing 12.5% of the premium. On our YouTube channel, Rob and Maria Trading, some of our viewers asked us that we create a smaller fund to show examples of how they might trade with only 6 trades a day. On October 1st, we created this account. As you can see, it's up 27% in 75 days, and that's about 108% annual rate of return. Over the next few minutes, we're going to show you how AI identifies high probability trades, how AI robots execute those trades, and how repetition creates an edge. In order to make it easier to understand, we're going to break this up into 5 short videos. The first one is the setup. For purposes of this presentation, we're just going to go over the MEC trades and the EMA trades. A MEC trade is a multiple entry iron condor. It's going to be entered multiple times a day. That consists of 2 parts. You're going to have a put credit spread and you're going to have a call credit spread. Both will be entered at the same time and they'll both be entered at the same price. We always sell for credit. So you're going to sell a put credit spread and a call credit spread. You're going to sell the short leg on each one of these spreads for a certain amount of premium, say $2. Then you're going to have to buy the long back, let's say for 5 cents, and that will give you a net price of $1.95, which is $195 if it goes to expiration. The second trade that we do is the EMA, or exponential moving average. This is going to be either a put credit spread or a call credit spread. And what we do is we compare the 20-minute exponential moving average to the 40-minute exponential moving average. And so if the market is going up, we're going to sell a put credit spread. If the market is going down, we'll sell a call credit spread. A little bit about nomenclature. If we say we're doing a 1002 $2 MEC with 150 W, 95% stop loss, what that means is 1002 is going to be the East Coast time. Then $2 will be the amount the robot will enter for either the put credit spread or the call credit spread, just for the short leg, not for the long leg. And if it's not exactly at $2, what you do is go and nickel down, nickel up, nickel down, nickel up, and try and get as close as you can to $2. 150W stands for the distance 150 wide between the short leg and the long leg. Now, we don't use the long leg as a stop loss. What we use it for is buying power reduction. For every $10 of strike movement, you're going to increase the amount of buying power required by $1,000. So if you have 20 wide, it's going to be $2,000 in buying power for that trade. 100 wide will be $10,000. 150 wide will be $15,000. Pick the biggest buying power that you can afford. We'll show you how to do it on the next slide. What we want you to do is to sell the target premium for the $2, whatever it is on the short leg, and then buy the first long leg that's priced at a nickel or up to the maximum width of your buying power that you can afford. So let's say in this example, you could only afford 100 wide, right? So what you do is you sell that short leg at 68.35, you start going up to 68.30 or down to 68.30, 68.25, whatever, and you find that the first nickel is at 67.95. Even though it's not 100 away, you go ahead and sell that first nickel, because that would mean that you'll be using a lot less buying power for this particular trade. So always remember, go to the first nickel or for the maximum buying power that you're willing to pay for. This is the second most difficult slide of this entire presentation. 95% SL refers to 95% stop loss. What you're doing is you're telling your broker, if I lose a certain amount of money, if the market goes against me and I lose a certain amount of money, I want you to put in a market order and close this trade out. And so let's say they use 100% stop loss to make the math easy. And if you buy it, if you sell it for $1 and you say 100% stop loss, That means that if the market goes against you and that it's minus $2, you have to pay $2 to buy it back, that you go ahead and it triggers a market order. And because you collected $1 on the front end, you pay $2 in the back end, you have 100% loss, just $1. Now, you can rest a stop order or a stop loss order either at your robot website or at your broker or at the CBOE electronic book. Remember, the way it works is the CBOE electronic book, they break down every second into 10,000 milliparts, and then they send the order to the market maker who executes the trade. The way they order those trades is first in time is first in right. Retail sellers go ahead of institutional sellers. Now, your robot website is probably checking once every second if they're really good. Some of them only check once every 5 minutes. Your broker's checking probably every half second or so. And then the CBOE, you're actually in the electronic book. Also, so you need to be sure that you've got it on the CBOE. In order to do that, you have to be a single leg stop loss. You cannot be doing it by the entire put credit spread. So you can't be selling the long and the short. You can only be selling you can only be buying back the short. You need to make sure that you talk to your broker and you find out if I'm doing a single leg stop loss order at market, is that resting at the book or is that resting at the broker? Because some brokers like IBKR, they first try and put customers against each other so they can avoid going through the exchange. That slows down because they got to check. If there's nobody there, then they send it to the CBOE. Now you're way past down the line and time has passed. And you think milliseconds don't make a difference. They do make a huge difference. That's called slippage. So if you put in an order for 100% stop loss and it's got to go from the robot company, say to the broker, or the broker tries to put it against each people, or the broker just holds it there and then gives it off to the CBOE, those take milliseconds. And that time, that market that was at 100% loss to you has moved to 110, 120% by the time that order comes to the CBOE. By the time they fill it, you're paying 120, 125% rather than 100%. That's called slippage. That's why I tell people commissions are pennies. Don't worry about the commissions to the broker. The commissions are penny. The slippages are dollars. Find out exactly how your broker is doing it. We analyze every broker we use for slippage every single month, and we talk to them about the slippage because we want to really be sure we're minimizing the slippage. Okay, red alert. This is the most difficult slide of this entire presentation. We're going to talk about putting the stop loss on the short leg only and calculating what the stop loss means. And the formula is, if you have a 95% stop loss, the formula would be 95% times the premium received on the short leg only plus the premium received on the short leg only would issue the stop loss amount. Oh my gosh, Rob, give me some examples. Look at the slide. What do you know? We got some examples. So if the premium is $2 and you have a 95% stop loss, then you're going to have 95% of $2, that's $1.90, plus you got $2 in premium when you sold it. So $2 plus $1.90 is $3.90. That's your stop loss, $3.90. If the premium is $3 and you have 150% stop loss, well, then you're going to take 150% of $3, that's $4.50. You're going to add in the premium you got originally, that's $3, so your stop loss is $7.50. Let's take another example. If the premium is $1.50 and you have a 200% stop loss, then 200% of $1.50 is $3 plus the original $1.50 you got is $4.50. Okay, now the other thing, just to make it even more complicated, is that's selling the short. Now you've still got these longs. You got to sell the longs. A lot of people say, oh, just don't hold the longs for a lottery ticket. No, this is going to close out today. It's going to be worthless at the end of the day on these longs. So if you can get a nickel or 10 cents when your short gets punched out, then that's a great advantage. And people say, oh, it's only $5 or $10. Yeah, but if you're doing it, say 3 or 4 times a day, 10 times a day, and you're doing it 250 days a year, it adds up to a lot of money. How can you automate the selling of the long leg? Well, you can do what's called an OTO order. That's one triggers the other. So let's say we've got a stop loss order on our short, and that's going to our broker, and we're telling them to send it to the CBOE. Now we tell the broker we want an OTO, one triggers the other order on my long. Whenever this short is actually closed out by the CBOE, then we want you to sell the long at the market. And that way it will automatically be done. You don't have to keep running in from the beach in order to sell your longs like I used to have to do. Again, though, you have to make sure that your broker will do OTOs on those long legs on SPX. There is some buying power issues and there is some calculations for some brokers. So you do want to make sure that they do OTO orders on the longs. Before we go on this slide, just remember in that last slide, if it was confusing for you, just go back, watch it again, take a screenshot. You know, the great thing about YouTube is you can go back and go over and over and over again. Okay, so now let's talk about the EMA and how that's different from the MEC. Remember in the MEC, we sold a put credit spread and we sold a call credit spread. In the EMA, we're only going to sell either a put credit spread or a call credit spread. And how we're going to do that is we're going to compare the 20-minute exponential moving average to the 40-minute exponential moving average. And so if the market is moving up, we're going to sell a put credit spread. If the market is moving down, we're going to sell a call credit spread. This is great when the market is moving. We also think that it's highly unlikely that a market will go in one direction and turn around and come all the way back down enough in order to punch you out. That's what makes the EMA so effective. Remember, the EMA doesn't predict price. All it does is confirm direction at a specific moment in time. So it's not uncommon to have markets going in an M&M style and you're doing EMAs that are going up and EMAs that are going down all at the same time. But you are so wide out on those that you can still make money on both of them in the same day. Just like on the MEX, when you're doing the EMAs, remember you're going to go for that target price that we told you, say $2. You're going to get the closest one to $2, and then you're going to go out and you're going to start looking for the long leg. You're going to take the first nickel, but you're going to stop if you get out to your limitation of your 150 wide or 50 wide or whatever it might be. That's the end of part 1 of 5. If any of this free information is of any value to you, we'd sure appreciate it if you hit the subscribe and the like button. Go on to the next chapter and you're going to see all the different ways that we put these trades on. Welcome to part 2. This is a fun one because we're going to show you our back testing methodology. The trading day is divided into 391-minute increments. Each of the strategies we look at has both a put credit spread or call credit spread possible. So that's 780 trades a day. And then we look at 200 stop loss and premium combinations. For each possible trade, we look back 6 months. There's 250 trading days in a year, so that's 125 trading days. So that gives you about 97,500 trades for each individual back test. We run a new back test for each strategy, time, premium, and stop combo loss every single week. So every week we're going to back test all of these trades. Each one's got we've got 2 strategies, each with 2 trades per strategy, 390 entry points, 125 trading days, 10 premium targets like 75 cents, $1, $1.25, $1.50, $2, $2.50, $3.50, etc. Then we're going to look at 10 stop loss requirements, and probably it's going to be like 80%, 100%, 95%, 125, 150, 185, 200, 300, 700, etc. So 2 times 2 times 390 times 125 times 10 times 10 is about 19.5 million trades. And then you're going to add in our open range breakouts, our double calendars, our reverse iron condors, our wheel strategies, our naked puts, and you get over 20 million. That's a lot of trades. Now, all the information we're providing is free. If you find anything of value here, we'd sure appreciate it if you'd hit the subscribe button below. Welcome to part 3. Now we're going to show you what we do with 20 million back tests every single week. Each week we get the results of 20 million back tests from AI. Then we use AI to massage the numbers. We do a manual review. We send it through AI again, and we do a final review. Let me show you how. Once we run these back tests, we get a detailed trade log that shows every single trade, when it was done, when it was exited out, and the profit and loss, and all kinds of other information. We run all that through AI to analyze all 20 million trades weekly. As you might imagine, it took us a long time, almost a year, to train AI to do the results that we want. But each strategy will return 96,600 trades, and AI takes these trades and builds a summary database. Then AI performs 22 calculations for us using each 1-minute group. Now for this presentation, I only used 7 minutes to make it a little simpler for me to keep track of it. It took us about a year to train AI how to take all that 20 million back trade results every single week and to put it into an organizational spreadsheet that we can use to analyze the trades. Now, for purposes of this presentation, I only had it look at every 7 minutes, but you can see all the data that it looks at every single week on the right-hand column. Once we get that data, we run it through AI again just to make sure that we have all the data and organized exactly the way we want it. Again, this validation test takes quite a bit of time to do. It took us over a year to build it, but it's really important to make sure that the data that you have is valid. Otherwise, you might be making a gigantic mistake when you put on trades. A quick note about software. We use Options Omega to do all of our back testing. Options Omega is what we think is the best back testing software out there. We've tried a lot of them. If you want to get a 50% coupon, we have that in our YouTube channel and every single one of our videos. Just click on it, you get 50% off. They give us $15. We give that to the Humane Society to help dogs, cats, and all kinds of pets. So if you want to help dogs and cats and all kinds of pets, buy Options Omega at 50% off using our coupon. Also, if you want to see the type of chat that we're using, we use the $20 version of ChatGPT. We used to always use 4.0. It was great. They went over to 5.1. It was terrible. We went back to 4.0. Just last week, they came out with 5.2. By the time you read this, watch this, probably up to 6.9 or whatever. But at 5.2, we actually like that one better. So now we're using 5.2. After we get the gigantic trade logs for each combo, we put that into AI. It kicks out a spreadsheet. Then we manually look at it and validate it. Then we send it back to AI for complete validation. Then it sends it back to us, and it gives us the spreadsheet you see here. We get one of these for each of the 200 combinations that we do. Then what we've got to do is we're going to have AI build that into a trade strategy in the next chapter. That's the end of chapter 3. Now, if anything you've learned in this with this free information is of value to you, we'd sure appreciate it if you hit the subscribe and like button. Let's get ready to go on to chapter number 4. We should have a link right here so you can just click to it. Chapter 4, one of my favorite parts, accessing the ATM, the AI trading machine. This is something we invented. We're going to show you how we do it right now. AI is a beautiful thing. We're going to show you how we use AI to make a money machine. We call it the ATM, the AI trading machine. Here we go. The ATM AI trading machine helps us decide exactly what to trade. It took us over a year to build it. We're still building it every day. We keep working on it. It creates the gigantic master database. It compares all the key metrics, every single trade against every single other trade, and helps us determine what are the best 125 trades for us to trade for every $1 million in buying power. Let me show you how. We're pretty excited because at the office here, we've now upgraded to our ATM 2.0, the AI trading machine. Version 2.0 now also looks at risk reward tolerance. It looks at sequential risk, which trades are improving, which trades are getting worse. It used to be that 1101 was the best, then 1551 was the best. I think right now 1206 or 1222 are the best. It also looks at the momentum of change. It also looks at the momentum of change relative to others. So you see what the momentum of change is to the 1206, 95 cents premium, 150% stop loss EMA versus the $2 MEC, whatever, the 150% stop loss. And so it compares those and what's the momentum of change relative to others. It then produces a lot of pivot tables. And most importantly, we operate different funds and they have different risk tolerances. And it comes down to max drawdown really versus it's risk versus reward. The risk is their max drawdown. A lot of people can't handle more than 10%. I'm one of them. I don't like being down more than 10% in the account at any one time. So if I'm going to limit my max drawdown to 10%, then that's going to limit my reward. That's going to limit the output. Other people, they might be able to take 20, 25%. I got a wife, I got kids, I got grandkids. I've been a gambler for a long time, and I know you can get sequential risk. I've seen it happen, whether it's playing blackjack, whether it's playing baccarat, whether it's playing poker, or whether it's gambling on sports. You see the sequential risk runs, and you have to be really careful about it. But the ATM 2.0 takes all that into consideration. Let me show you how. The first thing the ATM 2.0 does is it does what we call the stoplight analysis. And here you see the stoplight. Um, the, the best ones are green, the middle ones are yellow, and the worst ones are red. These are still, of the millions and millions of trades we look at, these are still the best strategies at the best times. You also see two brown ones at the top. Those are exceedingly good. So they're all relative to each other. So in a $1 million fund, we might be putting on a one lot on the pinks, a two lot on the yellows, a three lot on the greens, and a five lot on the browns. And we'll do 125 trades every single day. And we'll spread it out amongst that stoplight. In this particular purposes, I just looked at every 7 minutes to make it kind of simpler. What the ATM then does after the stoplight analysis, it starts to look for islands of time because you don't want to be bunching up your risk. You want to be sure that you're uncorrelated. Next, the ATM will display and do a check of what the day would actually look like. And here you can see in time order what the trades are, what the sizing is, and when they're going to be going on. The next thing that the ATM does is it compares the sizing to the entry time. You want to be sure that you don't overload a particular time with a bunch of trades. Wouldn't want to put on 20 different strategies at 12:56. You want to spread them out throughout the day so you don't have any, you want to be sure they're uncorrelated. The next thing the ATM does is a resource allocation analysis. You want to figure out how many trades you can put on during the day. If everything would go the best it possibly could, you don't want to overuse your buying power. This is everybody's favorite slide. It's the last slide of this particular chapter, but this is where the ATM computes your final sizing, resource allocation, and your buying power. Let's take a quick look here if I can get my little cursor thing to work here. So I'll highlight it here. All right, so as you can see here, we started this day with, this is a sample fund. For every $1 million in our fund, we would run something like this. So at the start of the day, we had $1 million, and then we're going to look at, this is our stoplights, and we're going to say, here's the EMAs, and here's just the non-EMA, the MEX, and we're going to figure out how many of these are we going to do. We're going to, in this particular analysis, the browns were 2 lots, the greens 2 lots, the yellows 1 lots, and the reds 1 lots. And we'd say, okay, this is how many we're going to have. We're going to have 1 of the browns, 5 of the greens, 9 of the yellows, and 3 of the pinks in the EMAs, and likewise in the MEX. Then it calculates what the buying power, this is 150 wide, so the average buying power we know is going to be around $12,000. Theoretically, it would be 15,000, but that would be the worst case scenario when you're actually out 150 wide. We know later in the day, as you get especially down to the 1551s, are about $2,800 in buying power. So the average is around 12. So then it calculates the total buying power. We know that we started with $1 million. I like to do a naked put NQ strategy in all of our funds. It's something that I've been doing for 4 or 5 years. It pays off routinely. I'll have to do a video on it someday, but I hold 30% back for that. And then I hold back 5% as just a safety factor in there because I'm kind of a worrywart and I'm super conservative. So that leaves $650,000 in buying power for every $1 million in a fund. And so then with that 650,000 available, we see that we've done about $642,000, which will produce, this shows you the premium that you'll produce, which is about 24,000. We know our capture rates between 10 and 15%. We'll use 10 and 17%. We'll use 13. That means we got to make an average profit of $3,172 per trading day. We know there's about 240 trading days in the year because we don't trade FMOC. We don't trade FMOC minutes days, which comes 3 weeks later. And then there's some half days in there that we don't like, holidays, that kind of thing. And so that should produce a profit of about 761,000 without the NQs on $1 million. So that's not too bad. 76% rate of return. This is the part everybody loves over here. And understand this is all theoretical. This is why math makes money. Math makes money. Everything we do is based on math. Trade small, trade often, trade with your head, not with your heart. Math makes money. Okay, that's the end of chapter number 4. All this information is free. If you find anything of value, please subscribe and like to these videos. We'd really appreciate it. Let's go on to the final chapter and take a look at our results as well as forward testing. Welcome to chapter 5, the final chapter. We're going to talk about activating the robots and forward testing. Although we do 30,000 trades a year, we don't use our fingers for anything. We don't use a keyboard. Every single trade is put on by the AI robots. I'm going to show you in this chapter exactly how we do it, and then we're going to do some forward testing to make sure that everything that we've done comes out according to what we thought it would do. In order to build a robot, the first thing we got to do is go to one of our back tests, and we're going to say create automatic strategy. Again, this is all done in Options Omega. We like this back tester because it's really easy to create robots. If you want to get 50% off, there's a coupon down below. You get 50% off, and they send me $15, which I just give to the Humane Fund to help dogs and cats and pets. So if you want to save the dogs and cats and pets, buy your Options Omega using the 50% coupon from my website, our YouTubes here, and we'll all be better off for it. Now, here's the slide and screen that shows you exactly how we're going to build this robot. First thing you're going to do is fill in all the choices, and here's all the choices you're going to get as you start to build this robot. A lot of it will already be pre-filled in on Options Omega from the back test, but there's still thousands of opportunities for you to make mistakes or to customize your particular robot, and that's the start of it right here. But you're not finished now. Once you do all the initial things, then you have to set up your robot by leg groups. Remember, we're putting on a put credit spread and a call credit spread, and then we're doing the stop loss on the short leg, and we're doing the OTO trade on the long leg. If you don't know what that is, go back to the prior chapters. Here's where you put that on. Again, thousands of combinations. Once you do the initial robot setup, once you do the legs, then you're still not done. Now you've got to do the exit conditions. There's a whole bunch of exit conditions here. You can see what they are, thousands of these. You got to make sure that this is set up for every single trade that you're doing. Okay, so you set up your entry strategies for your robot. You set up your leg strategies for your robot. You set up your exit strategies for your robot. Now you've got to do the Punisher. This is fees, commission, slippage, entry and exit windows all need to be put in here. Lots and lots of options, as you can see, on how to set it up. Here's what the screen looks like. All of this is on Options Omega. Don't forget to save those cats and dogs and pets by using the 50% coupon down in the links below. Once you've done all those things to set up your robot, the next thing you need to do is to automate it, and you do that by just clicking the Automate button. Once you do that, you got to click the Is Active button, and now the robot is trading. Wow, that's complicated. There's a lot to it. There's absolutely a lot to it. There's a lot of opportunity for human error, and it even gets a little bit worse because now you've got to turn off every week, every Sunday night, you're going to have to turn off all 125 robots, turn on all 125 new robots. That can take up to a minute or two each. And so if you're going to do 125 off and 125 on, you can do the math. That's a lot of minutes. You're still not done. You still have to click live and then you are live. All your trades will go live. All your robots will go live. And now you're just going to sit back and watch your trades in real time. So after you're done watching your trades in real time, we get to the results. Everybody likes this page. This one's a little different because it's just different days. But you can see here we had $188,000 profit for each $1 million we had in the fund. This was over 90 days. We did 7,700 plus trades, collected $1 million in premium. There's some trades going off automatically. We had a capture rate of 10%, kind of low actually. Normally it's between 10 and 17. And winners and losers. And you can see we made 18.87% in 90 days. And we're normally between 54 and 72% annual rate of return. So that's about right. Okay, only one more slide after this one. Remember what you've learned today. We're going to test, we're going to trade, we're going to repeat. Math makes money. Every single thing we do is based on math. We base with our heads, not with our hearts. We never try and predict the market. We have a positive expected value on every single trade that we put on because we do 20 million back tests a week. Then we run it all through AI and it tells us what to trade and when to trade it and what strategies. That's what you need to do to put on 30,000 trades every single year and to be extremely profitable in it. Okay, last slide, we're going to say bye-bye. If any of this free information has been of any value to you, we'd really appreciate it if you could go on to our YouTube channel, Rob and Maria Trading. And if you could subscribe and hit like to any of the videos you've seen, we'd really appreciate it. On that channel, we do tell you a great detail how we trade SPX. We go a lot of stock trades. My wife, Maria, she does a lot of trades in both options and stocks, earnings trades especially. And she's very, very successful doing that, more successful than me, actually. And then Tyler, my son, he's 30 years old. He started his fund 3 or 4 months ago. He's up 10% every single month. He does primarily the wheel strategy, and he does a lot of day trading scalps on the NQs, and he can show you how he does that. At any rate, we have a lot of fun on our channel, but it is very serious. Everything we do is based on math. Remember, trade with your heart, trade with your head, not with your heart. Trade small, trade often, and math makes money. You have a great trading day.